Responsible investing has become the new norm among investors, and it's something they increasingly demand rather than just prefer. They particularly want to back projects that tackle climate change as well as social issues such as child labour and gender parity. Two instruments for this are green fixed income bonds and social bonds. Well, to find out more, let's meet our guest today, Jean-Jacques Barbaris, Head of Institutional and Corporate Clients Coverage at Europe's largest asset manager, Amundi. I'm Sarah Lockett. Welcome to the London Stock Exchange studios. Jean-Jacques, hello.
Hello.
So you've been focusing on climate change for quite a few years now. What exactly are you doing?
I think it's important first to take a step back and to explain what climate change is important for financial players like us. I think basically what we do is allocate capital. So in a way, the role we have to play vis-à-vis the climate change challenge is to better allocate capital in favor of energy transition in particular. And this by taking two risks into consideration: the physical risks that may have an impact on the assets we're managing, and second, the risks that are linked to the transition that we try to do. So basically we try to do three things about climate change at Amundi. First, we try to integrate climate change within the way we assess companies. So it's basically an element of assessment of the performance of the company. That's the first thing we do. The second thing, we engage with companies. So for instance, every year we engage companies on their CO2 emissions. And third, we try to build up some innovations in order to create some bridges between what the investors need and what are the priorities to be financed.
And what is stopping people and institutional investors investing ethically or green? What are the barriers?
I think the main barrier is intellectual. That's probably the biggest one. At the end of the day, for me, investing in climate change is nothing to do about ethics or moral. It's not a question of value. It's a question of doing properly your job, financially speaking. So basically respecting your financial duties. And I think that's when this intellectual border is crossed, if you allow me the expression, then investors start to act.
And often clients want their return on their investment quite quickly, don't they, in 2 or 3 years or something? And how do they need to change their expectations with green investing?
But I think first they need to understand that climate change is often considered as a long-term challenge, but the truth is its impact on valuations and the returns you can get is already there. I take a very concrete example. We have a bill that is now being passed in France that is going to ban all the thermal motors in the car industry on the territory in 2030 in Paris. 2030 in Paris is tomorrow. So actually it means that this is clearly a part of short-term valuations that needs to be taken into account. And if you look at the markets themselves, we run a study last year on the different equities market all around the world, which show very clearly that investing with an ESG approach, particularly on the the environment part of it, was providing returns additional to a standard one. Why? For one very basic reasons, because it's demand and offer play, and clearly there is increasing demand for stocks of companies that are engaging against the challenge, and therefore this has an impact on the price. So it's not only long-term perspective, it's now for investors to take that into consideration. And
if we think about the Western world, the developed world, it's quite a mature market for green investing, so governments are financing all sorts of projects. So how do you have to change geographically where you look for opportunities?
But I think first it's part of the challenge itself. If you look at the BRICS, they represent already 40% of the total emissions worldwide. That's why they were included in the Paris Agreement. It means that there are some massive financing needs in emerging countries to address the challenge and to make sure that they can do their transition. So therefore, it's of great importance also to create some bridges between institutional investors' appetite in the Western countries and the needs that are in emerging countries. At the end of the day, it's good for the transition of these countries, and it's also an additional source of returns for the institutional investors in the Western world.
And your latest news is you now have a social fund, and you're soon going to have an inequalities fund. So tell me about that.
At Amundi, we're focused on climate and social inequalities. First, for one reason, because we believe at some point in time the challenges concur. You can only achieve the transition if it's done in a fair and just way. That's, I would say, the just transition. And therefore, we also consider there is a very strong value proposition to be built there. If I sum it up in 1 second, we have all seen that social inequalities, when they're too high, can challenge the way, let's say, liberal Western democracies work, and therefore have a very strong impact on value. Therefore, the question is, how can you address that if you're an investor? And so the fund that we're going to launch through our subsidiary CPR will be exactly about that. How do you invest into companies that commit themselves to reduce social inequalities at worldwide level?
Really interesting. Jean-Jacques, thank you very much.
Thank you so much for having me.
And that's all we've got time for at the moment. So from me, Sarah Lockett at the London Stock Exchange Studios, it's goodbye and thanks for watching.